Hey, welcome back to our channel, and in this video we are going to talk about how you are able to actually buy a rental property. It could be a first, second, or third rental property without having any cash in your bank, have any cash available. Now you might be wondering, well, lenders don't actually have any down payment options where the down payment is 0%. Lenders require a minimum of 20% down payment when purchasing a rental property. So how will I get this done without having any cash in the bank? Well, firstly, you need to actually own a home, and your home actually has to have equity in it. So for example, let's say you bought a property for $500,000, and let's say over time that property is now worth $600,000, and you have a mortgage of $400,000, for example. Well, your equity in that home is 600,000 minus 400,000. It's actually $200,000. So equity in your home is basically the market value of your home, and you subtract any debts associated with that property. It could be a first mortgage, as stated in the example, or it could even be a home equity line of credit, or both. You might have, a first mortgage of $400,000 plus a home equity line of credit, which is also called a HELOC of $50,000, and that's $450,000. So if your home is worth $600,000, you minus the 450, your equity in that home is a total of $150,000. And there's two ways of taking the equity out, either by selling the home or by refinancing your property and either obtaining a first mortgage or a home equity line of credit, also called HELOC. As stated, you have two ways to take out the equity out of the property. You could either sell the property, but if you sell the property, you're not accumulating more properties. If your goal is to accumulate many properties, so eventually they're all paid off, and when you retire, you have the passive income coming in, well, you don't want to sell your property then. Also, when you sell your property, there may be some tax implications depending on where you live. So many people actually refinance their home and obtain a first mortgage or a home equity line of credit because it allows you to keep one property and use that home or leverage that home to purchase your second, third, or fourth property. And this allows you to slowly pay off, both homes over time, and then eventually live, debt-free. And your home that you're living in is, mortgage-free. You're not paying any mortgage payments to that home. And then your rental property actually has rental income coming in to offset all of your living expenses, or at least some of your living expenses. So a first mortgage or a HELOC is a typical way to refinance, and you're allowed to refinance up to 80% up to the value of your home. So for example, if you have, a $500,000 home, you're allowed to refinance up to $400,000. It's a rule across Canada. And it also depends on what you're planning on doing. So if you're just getting a home equity line of credit, the max on the HELOC portion is 65% of the value of the home. So if you have $1 million mortgage, your max HELOC could only be $650,000. But then you could also get a first mortgage of $150,000 to go up to the total of 80%, which is $800,000 of the 1 million. Now, when buying your second or your first rental property or second or third rental property, and you're using your current home to buy that property, so you're basically refinancing, obtaining a first mortgage or a home equity line of credit, and then using those funds as a down payment on the next property. And you might be wondering, well, do I take a whole new first mortgage or a HELOC? And that depends on what you're using the funds for. There are many pros and cons, and we talk about this on our channel. There's a refinancing video. We talk about that in detail as well. But pretty much, a first mortgage means when you increase your first mortgage, you're responsible as of day one to pay the principal and interest on that mortgage payment, even though you might not be using all of the funds. Now, with the HELOC, you could actually obtain, let's say, $100,000 or $200,000 HELOC, but maybe you only need to use $25,000, $35,000, or $50,000 out of the 100 or 200. Well, you have a lot more flexibility, and you only pay interest on the money that you actually use. So if you're using $50,000, you pay interest only on the $50,000. Now, the con with a HELOC is you actually pay higher interest. So with the first mortgage, you actually pay a lower interest rate, but then your monthly cash flow is higher. Now with the HELOC, it's a totally open product. There's much more flexibility. You could pay off the funds anytime, you could borrow them back, and so on and so forth. So there's a lot of pros and cons, and it ultimately depends, how much of the money are you using? Are you using the money right away? Because sometimes if you keep a balance on your HELOC for too long, you actually end up paying a lot more interest, and it actually makes sense to consolidate that into your first mortgage, because with every mortgage payment, yes, you are paying a little bit more because it's principal and interest, but you're actually paying that debt down over time. If you just keep the money in your HELOC and you don't make any extra payments towards it, in 12, 24, or 36 months go by, you're simply just making these interest-only payments, but your principal portion hasn't gone down. So with the first mortgage, you could save a lot of money. So again, you always want to run the numbers and see what you want to do. If you need $100,000 to buy a rental property and you have the ability to increase your first mortgage, it's a great idea as long as you could afford it as well. And you got to see how much money is coming in from the rental property, which would offset your costs as well. But it's a great idea because you could actually pay down the debt over time while your rental property is appreciating. And even if you're kind of, deciding what should I get both? You could actually get both. You could get a first mortgage and a HELOC. So again, you always got to run the numbers and see what makes sense. Once you've decided which route you want to go, either through a first mortgage or a HELOC, and you have the funds, you could actually use those funds and use it as a down payment on your next property, which is a rental property in this case. And when you do that, there's actually a lot of tax advantages too. For example, if you are borrowing, let's say $100,000 and you're using that as a down payment on your rental property, the interest that you pay on the $100,000, either it's a first mortgage or a HELOC, it's actually a tax write-off against the rental income that you earn on your rental property. Now, we always recommend speaking with a certified accountant, a CPA, to get all the correct answers and double check everything there as well. But there are tax implications that are in your favor when using a first mortgage or a HELOC funds to buy a rental property. Now, in regards to cash flow, the goal is you want to buy a rental property that the rental income actually covers the first mortgage on the new property, the property taxes, you might have a strata cost, home insurance, maybe a repair expense. Also, you want the cash flow to cover the interest portion on, or even the payment on the first mortgage or HELOC. When you get a first mortgage, you may not cover the whole payment just because you might have your principal residence mortgage in there. But when it comes to a HELOC, let's just say your interest only payment is $300 a month. And you actually want to do the calculation. So that $300 a month is not coming out of your pocket. The rental income is actually getting paid. The rental income is actually paying for all those costs. So you want to look at the cash flow as well. And you want to get a rental property. And that's just another topic. But that's the best way to do it. So you're paying minimal costs out of your pocket. So now all of a sudden you leverage your current home to buy another property. And at the same time, it doesn't really cost you anything extra. And again, this is if your property cash flows. Depending on where you buy, you may need to put some extra money in your pocket because cash flows are all over the place throughout Canada. But the ideal scenario is you leverage your home, you didn't use any cash in your bank account, and now you have the second property, which is a rental property, and all the costs are associated with that rental income are covered. And you're basically living the same way you lived before, except you have another property. And this is one of the fastest ways to increase your net worth. And you could do this for your third, fourth property as well. So for example, you have your principal residence home, you used it to buy your second rental property. Then you could refinance your second rental property over time if it goes up in value or if you pay the mortgage amount down. And you could use that to buy your third rental property and so on and so forth. And just keep doing that and continue the process and just reach your goal. You might have a goal of 2 properties, 4 or 6 properties. But again, it can take a very long time to save up a 20% down payment. A 20% down payment on a $500,000 property is $100,000. So instead, why not use market appreciation? Because values, depending on where you are, may go up much faster than your savings account. And instead of waiting to buy that property because you're waiting to save and prices keep going up and up and up and things keep changing, just use the property that you're living in now and leverage it to the next property and so on and so forth. Again, always run a cost analysis to make sure you could afford everything. And if you are paying extra money or payments out of your pocket, it's accounted for. Well, I hope this video was helpful and it gave you a few tips on how to increase your net worth as soon as possible, potentially buy your second or third rental property, become mortgage free as soon as possible, or even retire. Instead of retiring in 30 or 40 years, you may have a plan of retiring in 10, 15, or 20 years. We've helped many clients retire in how many years they want to. So don't forget to like, subscribe, share, and comment, and see you at our next video.